I've been doing a lot of videos on what I would call my next 20x growth stock. This stock has about 15x left, in my personal opinion. It has recently reported earnings. The stock is going down. I raised my fair value on the stock, my entry point, and I'm going to share all those things today and talk about it. So I really hope you enjoy it as always. Now, this stock is Ouster. Ouster reported earnings. The stock is down 7.5% in the after hours. It's still up about 95% year to date. It's my largest gainer in my portfolio. It peaked about $62 a share, and it's down about 28% or almost 30% from its all-time high. And I think the stock is starting to look very, very interesting. Now, Ouster is mainly a LiDAR sensor company and a camera sensor company, and they're the largest Western LiDAR supplier and camera supplier in general. So this is mainly a bet on anything that has to do with physical AI. So all the models that we're training and everything that we're doing will ultimately have to be applied to the real world through autonomous vehicles, autonomous driving, through a lot of robotics like in Amazon and industrial robots and humanoids and smart infrastructure and drone deliveries, and all those things require cameras and sensors. And Ouster is selling them. So it's like a picks and shovels play on physical AI. Instead of betting on who's going to make the best robot, they all need sensors, and Ouster is the biggest supplier of those sensors with partnerships with Google, Amazon, and so many companies that you're likely familiar with. I've done a deep dive before, so I'm not going to do it again. The company is growing revenues like never before, and this quarter was absolutely amazing for Ouster. The company grew about 56% year on year in revenues and 12% quarter on quarter. That was an amazing quarter. My fair value is based on 35% revenue growth. The company is growing 56%. It's growing 12% quarter on quarter. I mean, the growth over here is absolutely amazing. And if you think about physical AI in general, we're still in the early innings of this massive, massive revolution. We have yet to automate a lot of factories. We have yet to launch humanoids and robots. We have yet to use more drones and more automated, you could say, robots in military and defense applications to save a lot of the soldiers' lives that are being put on the Western Front. We could put a lot of those humanoids on the front lines instead of putting soldiers over there. So the upside here is just getting started. Most cars are not automated. So this is still in its early innings. And the company is growing 56% revenues. So I think it has very long runways. Now, the company's net loss was 18 million. It improved 2 million year on year, which was great. But most importantly, the company's non-GAAP margins are 53%, guys. 53%, up 2% year on year, and about 7% quarter on quarter. And that was the main argument I got on Ouster when I talked about the stock at $21 per share. I was told, what is the moat of Ouster? Ouster is just selling sensors. Any company can sell sensors, therefore they have no moat. And I was saying, if Ouster had no moat, then why do they have 40 and 50% gross margins? If the competition was so intense, their margins would be 5%, 10%, 16%. But the fact that they have those margins is because they have a technological advantage within a lot of those sensors. And they have the Made in USA certification, which no other LiDAR company has. And that allows them to sell, to be the only supplier pretty much, to a lot of the military and defense applications. That's why Anduril and other drones are using Ouster LiDAR sensors. But the stock did go down mainly because of guidance. So the company guided about 54.5 to 57.5 million in revenues for the next quarter. Now, this quarter, Ouster put up 55 million. Next quarters are guiding for 54.5 to 57.5. So the lower end, which is 54.5, is lower than this quarter of 55, which would imply a potential deceleration in quarter-on-quarter growth. And the market doesn't like it. But what a lot of people are missing is that this is something that Ouster does all the time. They do it pretty much all the time. So I told you how this quarter they made 55 million in revenues. Well, last quarter they put up guidance for this quarter, and their guidance back then was 49.5 to 52.5. How much did Ouster make? they made about $55 billion. And they're pretty much doing the same thing for next quarter. They're guiding 54.5 to 57.5. They'll likely do 57 to 60 million easily, in my opinion. But the market is still not recognizing that this is what Ouster does, and they're selling the stock again after hours. And it happens in every earnings report. But even if it was flat quarter on quarter, this is still 50% plus growth year on year. So the growth here is absolutely amazing for where we are in the cycle. Now, unfortunately, the company has been diluting shareholders a lot. Shares outstanding have been increasing a lot. Last quarter, they increased from 61 million to about 66 million. Now, the reason for that is because the company did a private, or I should say a public offering whenever the stock reached about $55. The stock was too expensive and they raised a lot of money. And I think the company did well by raising a lot of money in this time because the valuation was too extended. So they did the right thing, but dilution is still about, you could say, 20%, 15% on average. And that's not really good at all. Now, the company has been unprofitable, you could say, and this is a reason why it's been diluting, but it's going to get closer to profitability. And they're guiding profitability by Q3 to Q4 of 2027. So this is most likely going to happen. And once it does happen, the dilution should be much less for a lot of shareholders. But the company also has a great balance sheet, about $261 million of cash and no debt. So they have a very good balance sheet, which is great for such a business. Now, in terms of the valuation on Ouster, the stock right now is trading at about 14 times sales. When I diluted the stock, it was almost at 20 times sales. It was ridiculous. Now it's trading at about 14 times sales. It's better, but I think it's still a little bit extended for the company. Now, to be honest with you, 14 times sales is somewhat extended, but it's not really a lot if you think about what you're getting with the company, which is pretty much a picks and shovels play on anything that has to do with physical AI, with the company guiding 30 to 50% revenue growth for the next few years. You're paying about 13 times. That's really not a lot, in my personal opinion, but there's still, of course, a chance that they may not deliver on this growth, although I believe they will. So for me to give you a very simple valuation model on Ouster, and the way I look at it is I don't really want to pay more than 10 times sales for any growth stock. I never bought a growth stock over 10 times sales because I think if you're paying more than 10 times, the odds are mostly against you. So if we want to use that on Ouster, the company should make this year about $220 million in total. Now, $220 million times 10 is about 2.2 billion. So we take about 2.2 billion of a market cap, and we divide it by a shares outstanding of about 65 million this quarter. That would be about $34 per share. So I think around $34, $35 is a great buy for a company like Ouster. I think it would be really undervalued. But if you like the company for the long term, I still see a lot of upside from here. So if I use this 220 million of 2026 revenues for the next 10 years, and we assume that they grow 35%. The company right now is growing 55%. I think they can do it for many years to come. But let's assume they can get the lower end of guidance, which is 35%. In this case, you're getting about $4.4 billion in revenues 10 years from now. We could take this $4.4 billion and apply a 10 times sales multiple. That's about a $44 billion market cap. The current market cap is about 3.3 billion. This is about a 12x, 13x over the next 10 years with a company like Ouster. If you're buying it at 2 billion, you could likely get, about an 18, 19x on the stock. So I believe even at this price, the stock is not really overvalued. I think it still has, massive runways on the growth and massive runways for the business in general. But if you're trying to be conservative, I think $33, $34 per share is ideal for a company like Ouster. I personally trimmed a little bit of the stock when it was trading at about $45 not long ago. And what I did recently is I sold those call options on Ouster. So I sold a covered call at about a $95 strike for $600 per strike, per option. So what this really implies is that I'm getting paid $600 for every 100 shares that I obligated to sell at $95 by January 2027. So if Ouster gets to 95 by January, I have to sell 25% of my position. And I'm getting paid $600 per contract to do that. This is an amazing deal where, again, you're getting paid $600 to sell Ouster at $95 by January 2027, which would be at like 27 times sales. I would be selling at least 20% of my position any day because the stock would be too expensive. So those are things that I also do in my group, and I share all of them in real time and everything I do. And that pretty much this option alone, the $600, is worth like 2.5 years of what I charge for my group, and I share it all in real time. And if you're interested, this is the link, of course. But I like Ouster. I like, the earnings report. I think the valuation is getting better, still a little bit extended. I think $34, $33, it would get to a great deal or too cheap to ignore territory. Right now, it could be fairly valued if you have a long-term horizon and if you're willing to potentially, start a small position and dollar cost average down. But that was my opinion on Ouster. I still have a lot of conviction and amazing company. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.